Welcome to This Explainer. Today, we're diving into a hidden world that quietly influences, well, literally every company, economy, and person on Earth. We hear about it every single day on the news, governments watch it like hawks, and businesses absolutely depend on it. But how much do we really understand about what's actually going on behind all those flashing numbers? Just listen to this. Every single second, millions of dollars are moving. Entire economies are shifting based on a system that we are going to decode today. Because it's not just scrolling digits, it's a massive living engine that's literally driving global progress. To really put this into perspective, I want you to imagine waking up tomorrow to find that a single company has become $50 billion more valuable overnight. And here's the kicker. They did it without building a single new factory, without releasing a single new product, and without hiring a single new worker. No way, right? I mean, it sounds like magic. How is that even possible? Who actually decides what a company is worth on any given Tuesday, and where did those billions actually come from? Well, to answer that, we've got to look backwards. Part 1. A world before stock markets, 500 years ago. So imagine you had this incredible idea to build a trade ship. The cost was way too high for one person, and relying on just one wealthy sponsor? Incredibly risky. I mean, if the ship sank, they lost absolutely everything. So merchants got smart. Instead, they started asking a lot of different people to contribute smaller amounts. If the voyage succeeded, everybody shared the profits. If it failed, everyone shared the losses. And without even realizing it, they birthed the revolutionary financial idea of shared ownership.
Part 2. The birth of exchanges and organized marketplaces.
As this whole idea of shared ownership really caught on and global trade expanded, investors couldn't just keep meeting randomly in local taverns or crowded public squares, hoping to trade their stakes, right? They needed something better. So they created organized marketplaces that eventually evolved into formal stock exchanges. This completely changed history. A business no longer depended on a single patron. It could raise money from thousands of people to grow at lightning speed. Trade expanded and innovation accelerated, all because great ideas finally had a place to find real funding. The stock exchange wasn't simply a place where money moved. It became a place where ideas found funding. Part 3. What exactly is a share? To understand this core building block, let's take that grand 500-year-old idea and apply it to something super simple, like your local pizza shop. Imagine a successful restaurant worth $100,000. The owner wants to expand, but, they want to avoid taking on a mountain of bank debt. So instead, they divide the business into 100 equal pieces. Each piece represents exactly 1% of shared ownership. So a share is exactly that. It's a tiny piece of ownership in a business. Now, if you buy one of those pieces, you don't suddenly have to go into the kitchen and start baking pizzas yourself. But if the company's value grows because that second location is a huge hit, your slice of the pie, pun totally intended, becomes more valuable. On the flip side, if the business performs poorly, your piece goes down in value. You share the potential rewards, and for sure, you share the risks. So that brings up a crucial point. If a company like our pizza shop or, a massive tech giant hasn't built a new factory or released a new product today, why does its stock price constantly fluctuate every single minute the market is open? This is the exact question that confuses almost everyone. The answer isn't purely math, it's psychology. Imagine two friends bidding on a rare painting. One looks at it and expects its future value to be $1,000. The other looks at the exact same painting and expects it to be worth $2,000. The price rises simply because they value its future worth differently, based entirely on their own human expectations. And the stock market works exactly the same way, just on a massive global scale. Millions of investors are constantly evaluating all these overlapping factors. They're looking at future profits, new products, changes in leadership, looming competition, economic conditions, consumer demand, interest rates, and global events. Every single time a buy or sell order goes through, it's really just someone expressing their personal opinion about the future. A stock price isn't just a calculator measuring what a business is worth exactly right now in this very second. Actually, it's a forward-looking machine. It's a snapshot of what millions of people collectively believe tomorrow, next month, or even next year might look like.
Part 4. The market never sleeps.
You see, this expectation game doesn't just clock out at 5 p.m. Even when the physical exchange buildings are closed for the day, the flow of new information literally never stops. A sudden scientific breakthrough at midnight, or a major geopolitical event over the weekend, instantly shifts how investors view a company's future. By the time the opening bell rings the next morning, expectations have completely transformed.
And that is exactly why prices gap up or plummet so rapidly once trading officially begins. The market is constantly digesting a new reality.
So, we've successfully uncovered the first layer of this global mystery. The stock exchange isn't just a cold building filled with scrolling green and red numbers. At its core, it's a beautifully complex, massive system built entirely on shared ownership, human confidence, and our collective expectations about what the future holds.
But, well, that leaves us with an absolutely massive question, doesn't it? If the barrier to entry is so low now, and anyone with a smartphone can buy shares, how do the actual mechanics of profit and loss work? Why do some investors build enormous fortunes over time while others lose it all on a single bad bet?
In our next explainer, we're going to answer exactly that. We'll be exploring the real-world practice of investing, breaking down things like dividends and market indices, and revealing the proven principles of successful long-term investors. Until then, I want to leave you with this. When you look at a successful company today, are you seeing what it is or what it's going to be? Stay curious, and we'll see you in the next explainer.